Advanced Consulting Group. My name is Erin Marr with iPlan Group, and I'll be your moderator today. Throughout our presentation, we encourage you to interact with our speakers by typing in questions and comments using the questions pane. We'll be answering questions after the presentation. If you'd like to join the conversation on Twitter, please use hashtag #ILearnIPlan. We'd love to have you connect with us and keep the conversation going beyond today's event. Also, we are recording today's session, and we'll make the link to the recording available post-event via email. It should be available in the next day or two, so keep an eye out for that in case you miss anything during the actual initial presentation. Now on today's speaker, Jeff Kanter has over 16 years experience in the financial services industry and over 6 years of implementing the infinite banking concept for his clients. Additionally, he provides ongoing coaching to further develop and grow his clients' banking programs. Today, he'll actually be presenting you with a nice overview of infinite banking, as well as demonstrating the benefits of becoming your own bank and how to apply the concept to your everyday personal or business life. And without further ado, let me introduce you over to Jeff Kanter. Jeff, how are you doing today?
All right, thanks, Erin, and welcome everyone to the call. What I would also tell everybody at the onset is that if you have to leave abruptly for some reason, sometimes things come up, definitely send an email in for some questions or whatever, or if you wish us to follow up there with you or send you some info, I will be glad to do so. I'm not quite sure where everybody sits in terms of their money expertise, but that has become what's the forefront of one of the things I discovered through internet banking is that the lack of knowledge of money in the country is rather scary, to be sure. And I'm actually showing up to start with a quote by the founding fathers, because their concern was what was going to be the demise of the country, and they didn't think we were going to be attacked from without, but they thought that everyone in the country would not know how money works, and eventually the banks and corporations would get control. And rather coincidentally, that's fairly close to what's actually been happening. So, but luckily there's ways you can take control, and that's really what it kind of boils down to is, are you going to have control? And at the moment I'm having a technical difficulty. What has happened? Well, this is rather confusing. I'm actually having a technical difficulty. Oh, there we go. Okay. So the idea is you want to be able to leverage or increase your cash flow. And so besides investing or whatever anybody's engaged in, and typically even just most people that I deal with a lot of time just actually have just a job or a career, and they aren't even doing much in the way of investing, maybe other than a 401k, or and some of the people on this call maybe with a self-directed IRA. But there's some very important economic principles that affect everything that you're doing. And whether you know it or not, and that always is the problem. People say, well, I don't care about inflation or this or that, and it doesn't matter because whatever is going on in the background affects you anyway. So here's the key, and it always kind of boils down to cash flow, because for a lot of people, they think that they have to invest, and investing is a wonderful thing to be able to do, but not that many people have enough disposable money to be able to invest, but they do have jobs which creates cash flow. And that's the thing they need to understand, is that anything that they're doing, they're either going to be paying interest or they're losing interest. There's no kind of middle ground. The money can either be making money for you, or you're losing the money that it's making for some other person because you're paying an interest cost. But here's the big difference between the typical person and those that are really connected financially, is that they utilize these principles every day. A lot of people even know these principles, but they don't apply them. And therefore, they're definitely not going to have any success out of that. You have to look at it this way. You have to figure out how's your money deployed, because at first you have to start to analyze, and this is kind of a little lead up to the bank, but a little bit is to understand how money works and kind of sets the stage for how you can capitalize on having a bank. How is all of your money deployed? If this represents your cash flow, your whole pool of money, ideally you're supposed to be saving about 5%, although we're historically lower than that, but the gurus say 5%. Well, realistically, there's this other part over here, and this is the 35% approximately that the average person or business pays in interest when you add in car loans, student loans, mortgages, credit cards, leases, equipment loans. When you tally it all up, that's the national average. So that being the case, here's what you're up against. If this is your pool, how much return do you need to try to make on that 5% just to try to break even into the future? You got to get a 690% return. So I really don't know anybody that's able to accomplish that with any regularity. So here are the concepts you need to understand, and one of the big ones is inflation. These numbers here are rather low, truthfully, because inflation's running at a little stronger rate and maybe higher still to come. But ostensibly in 2012, if it's $100 to buy 3 bags of groceries and you're going to retire in 2032, it's going to take 167. So the question would be, is your income increasing fast enough? Are your savings increasing fast enough just to compensate for inflation, let alone anything else that you may want to try to accomplish? The other is understanding the need and the power of compound interest, which is oftentimes referred to as the rule of 72, which is the time it takes for money to double. So here in this example, at 4% at $10,000, it's going to take 18. I'm sorry, at 4%, it's going to take 18 years to double, 12 at 6, and 9 at 8. But notice the difference, though, the power of the compounding. By age 70, the person has 40. At 70, they have 80, and at 8%, they have 160. Well, from 4 to 8, we only doubled the interest rate, but we quadrupled the amount of money that the person had. And I'll talk to clients that may understand or even know if I ask what is the Rule 72, and then I turn around and say, so how do you apply it, though? And no one ever seems to be able to or is. And that becomes the fallacy of not understanding or utilizing these basic concepts. But here's another big one, risk. And this is an area where a lot of people are either told that risk is not a problem because you're young and you can make that back up. But the truth is, if you can involve yourself in a way where you never take risk, is the optimal way to be. And so that's the kind of the precept that you always want to bring to the table is how can I be doing something that's risk-free as opposed to something that has some risk involved in it. And this will give you a little bit of an idea here to put that in a bit of a perspective on that breaking even. And you start thinking a little bit about some of the market dips. And the idea is just trying to get back to where you were as opposed to where you should be if you've not had any losses along the way. And in fact, it gets to be pretty powerful. So it's going to be very hard to make up for any losses. And then, of course, people get confused, too, by watching too much television or watching too many people on TV talk about money, and they'll pay attention to, say, rate of return. So here's a way to sort of demonstrate the realities of that as well. So this is a $100,000 investment in this, and these are actual stock market years that we picked. So what is the average rate of return of all of this? Meanwhile, we're at a loss, but there's actually an average rate of return of 3.5%. So you have to understand math and not pay attention to the materials and things that you're being shown as far as how and what you should buy. But this, unfortunately, here is the biggest threat of all. And it's going to be the most challenging thing you're going to be faced with in terms of accumulating money. It's rather comical to read this, but sadly very true. The ultimate irony is on the estate taxes. You've already paid tax on all that money all the way through, and on the way out the door, they want to nick you one more time. So the goal is you want to avoid tax, and this will show you a little level of how corrosive it really can be. So let's say that we have $1 and we double that dollar every year. So in other words, it's $1 and then $2 and $4 and $8 and all the way out. So 20 years, we'll be sitting with $1 million. So I tell everybody, sort of think of that as the amount of work you put in. You work for 20 years, $1 million of cash flow flowed through your hands, but then you happen to be in a 17% tax bracket. I usually challenge everybody to try to imagine what that amount would be that's left. That'll save you the math. So most people guess, 800,000 they'll still have or whatever, but it gives you an idea how much corrosiveness there is on tax over time. And then, needless to say, a lot of people are in higher tax brackets than that. So here's what it looks like at 27%. Rather appalling and consider the person who you're paying all these taxes to, I don't think, come over to your house and help clean up or do anything of any consequence. So are you getting service for those dollars that you're giving away? And also you have to think about the environment. A lot of people try to ignore that. They act, again, besides denying inflation, other monetary and international things that are brewing out there. Or we may pay attention to some wars and whatnot. But here's a simple example of some things that not very many people are aware of. And this is the amount of cars. This is a Google Earth photograph of all of the brand new cars that are not sold and never will be sold. And this is all over the planet, or places like this, because the countries are too concerned about the people that are dependent on the auto industries, from the fuel to the windshield manufacturers to everybody else. So all these cars continue to be stored, and they also can't be sold because it will disrupt the used car market as well. But the potentialities of all this is what's brewing in the background that you need to prepare for, independent of the job that you have. And here's just another little myth buster here, but you understand the differences between annual percentage yield. So here we are depositing $1,000 at a normal bank where we're going to get a 1% return, which would bring us $10. But on the annual percentage rate, if we turn around and borrow the bank $1,000, have to pay them $10, 10%, then we're going to be paying $100. So the bank's supposed to be making the arbitrage, the spread between there, which would be the 9%. But in fact, 9% on the $10 is 90 cents. So in truth, the bank made a 900% return on my deposit, or your deposit, or everyone's deposit for that matter. Which begs the question, why aren't you there for the bank? And what I tell everybody is just start to get a handle on some of this stuff. Is everybody that I ever talk to, they're going to work for one reason, even if they love what they do, and that's to make money. And I ask them, why aren't you an expert on money? Because you went to work to get money. You seem to be an expert at work, but you're not too good when it comes to understanding how money functions. Well, as it turns out, there's 3 ways you can accumulate money in the United States, and here's a little chart you can just envision and fill it in for yourself how you have all of your money currently deployed. There's the tax now columns, the tax later, and the tax advantaged. So I know at least a percentage of the people on this call are using Roths because they're having a self-directed IRA with iPlan, and there's some other options too. So, but most everybody I typically encounter in one of the 2 first boxes, but they've already determined from our conversation that being tax advantaged is the best place to be, yet that's not where they have their funds. And when you ask why, there's never a good answer, and it tends to be whoever steered them in that direction, which meant to me that the thing they went to work was to get money, yet the first thing they did was give control of that money to other people. So why in the world would you want to do that when they're going to steer you into all the things don't benefit you but actually benefit them? But here's the key of all of these things on this page here. Which of these can you develop purely out of cash flow? Because as I mentioned earlier, investing is a challenge. So unless you have an IRA or something where you definitely have a pool of money, the average person can't figure out how to develop or build themselves a financial future except to measly save up a few bucks over time to hopefully one day invest. So that becomes the question, how can I develop all my money just like a bank does, strictly from cash flow? Because banks don't have any assets. All they have is depositors' money. And here's how Wall Street was able to get control. So let's give you a little idea of how everybody did lose control a little bit of their retirement money and even their money in general. Less than 5% of all professional managers, these are some statistics that are out there, can never match the Standard & Poor's in any given one year. But rather interesting, it's never the same 5% in any given year. So they can't even stay consistently. So there begs the question, how do you think that you're going to be able to do? So let's start talking about the bank for a moment. Let's start representing why this is advantageous. But you have to think of the bank as for what it is. It's going to be a business. It's a way for you to develop money, to set up a financial structure for yourself. So it's a business like any other. You have to bring that attitude with it, and you have to run it like a business as you see as we go forward here. But first of all, to put that into perspective and context, what does it actually take to start a business? Well, you're going to need some capital, and if it's kind of a retail-oriented place, you're going to need a location, probably going to need some inventory. You might even need some staff, signs, some advertising, some customers, and most everybody will tell you you need some good luck. But I always tell everybody good luck really just means you didn't know what you were doing, because if you buy a McDonald's, there's not much luck involved in that. So this is what you're really required to do. It's quite an undertaking, a lot of potential team members, a lot of things to coordinate, and a lot of opportunities for failure. And as we look at this list, it starts to look like risk, which is definitely not a good thing. So now let's see what it takes to start a bank. We're going to start a different business. Well, we don't need that good location, and we actually don't need any inventory, and we don't even need any staff or signage or advertising, and we certainly don't need any luck. And we almost don't need any customers because at worst, we're going to be the bank's only customer, but there's going to be opportunities for have other customers as well. But what we do need is cash flow only. And cash flow is something I already have, and there's no cost for me to start a bank. All I have to have is cash flow, and I'm able to launch my business. So here's what happens when you start to have a bank. I always ask everybody, when you start a bank, let me say this. When you have a bank, these are the key elements of what the bank brings to the table. You're going to be able to earn a triple compound interest rate. So here's what's going to happen. You're going to get interest on the principal, just like you would expect to get a CD or whatever. You're going to get interest on your principal. But here you're not going to also get interest that you would have paid out to other banks. And maybe getting a little ahead of myself, but because you're going to be lending to yourself as a customer and paying interest like you would if you borrowed from a bank, you're going to get that interest that would have gone to a different bank, which is money that leaks out of your world. So we tell everybody banks recycle money. They send it out, it comes back. What do most people do? Earn money and send it out, nothing comes back. And then third, you're going to earn interest on your interest. So you're going to be able to compound all of these dollars in a way greater than you've been able to in any other vehicle, especially when we look against that list of choices I showed before. So here's what I was getting myself confused between a slide alignment. What would owning your bank look like? So let's say we're starting to own your own bank, okay? So you figured out that I'm launching this new business, and it's going to take $9,000 to launch this business. So I always pose the question to everybody, let's say you start a brand new business, and as a percentage, at the end of the very first year, what amount of that $9,000 as a percentage you think you'll be able to take back out and pay yourself back? And our answer is as low as 0 all the way up to maybe 3 or 4% typically. But banks are designed to make money, and we own this bank, and we're not taking any risks, and we're not making any risky loans. So here's what happens for us. These, of course, are hypothetical examples. These are some actual numbers that I ran, but no two people will be exactly the same. But the idea for you here is to get the gist of how this thing functions. So in that first year, we put in our $9,000, and at the end of the year, we're able to pull out $5,851 to pay ourselves back, as it were. And I'll show you how we're going to loan and stuff. But again, I just want you to see how the money flows. So that being the case, compared to a typical business, how does this look for your very first year in business? Now we roll into our second year in business. What's that going to start to feel like? Well, again, we want to capitalize our business at $9,000. But now at the end of the year, we're going to be able to pull out $6,225 because, again, we're a bank. We grow. We have growth every year. We're capitalizing on our prior year's activities. How's our second year starting to look? Now we start to steer into the third year. We put in our $9,000 again for this year's capital. And at the end of the year, we were able to pull back out $8,503. Now how's the business starting to appear? But here's where it starts to get a little more exciting. And it gets a little more exciting every year thereafter. Because like any good new business, it takes a few years to really get the ball rolling, getting your customers going, your capital built, your return on sales. So here we are, we're coming into our fourth year in business. We put in our $9,000, and lo and behold, at the end of this year, we're taking out more money than we put in. And from this point on, every progressive year is going to produce a larger and ever larger amount than whatever it is that we put in. And again, everybody's situation could be different. Some people could be doing $1,000 a year. Others could be doing $20,000 a year. This just gives you the idea of how the numbers flow. So what does that mean in a real-world context? So let's take a car, and we'll envision what it's like to finance a car, and then I'll get into some of the actual numbers. You can see what some of the actual stuff flows in some columns. I have to shift gears here to an alternate little thing here. All right, so let's do this vehicle example. So we're going to try to compare it up against basically the three main ways that people or businesses acquire vehicles. And of course, businesses like the leases because it represents the write-off. Typically, most people finance, and then a lot of people think they're going to outsmart the other two alternatives by paying cash. But let's take a look and see what that would look like as opposed to doing our own bank. We're going to make it real simple, so we're going to not have a trade-in or down payment because we want all of these options to look side by side. And we're going to demonstrate a lifetime of buying cars. So the person buying their first car at 23 and their last car at 67. So that would ideally represent a lifetime of vehicles. Amazingly, the price of cars never changed all that time, and everybody always paid 8.5%. But again, we're not trying to play real-world numbers. We just want you to understand the concept here. So let's take a look at this thing here. And this becomes an important adage, is that you don't have to be rich to have a banking system to finance everything and build yourself a whole future. And again, trying to get everybody away from the idea that you have to invest. So let's do some comparison. Well, if we lease the car over all that time, we'll be out $175,000, and the lease company will have made quite a bit of money on our activities. The finance company will have lost a little less because it's a little cheaper to finance than to lease typically in the long haul. And by paying cash, we'll lose a little less also because we won't have spent any of those finance charges. But then there's our bank. But first, let's figure out how do we get this bank going. We didn't talk about that yet. I did a little bit before, but let's take a little closer look at that once again. So the key thing is we want to see how this is going to add up for us. So we're going to have what was showing on before was the capitalization phase. Because in what I was describing before, I said you could put in $9,000 and take out some money, but not what we were going to do with that money or anything. I was just demonstrating that you had access to funds. But here's the idea. We want to be able to have enough money to buy a car. So in that first year, we didn't quite have enough. So we might have to go through a year or two or so to be able to build up enough funds in there, in that business, to launch our business and get started. So we go through our capitalization phase. But then now, the rest of our life occurs because we're going to go into utilization phase. We're going to now pull money out, buy that car, set up payments back to our account, which looks like this. So now we start to replicate one of the two things that banks do very well. We're going to do both, but right now we're doing one of the two. We're restocking or recycling money because we're taking money that is our money, we lend it out to buy the car, we set it up for us to make payments back just like a normal car payment. So in this example, we're making 48 months of car payments at 8.5% interest rate back to ourselves. So as we continue forward and take a look at what that looks like in real life, here's what happened with our bank. We made $552,000 utilizing the exact same cash flow, the same cars we were going to buy anyway, but by directing the fashion in which we circulated the money, our money in our pool, we were able to realize a $552,000 gain and therefore have all those cars technically for free, as opposed to actually them all representing a loss. Even in spite of the fact that they may have been a business write-off, it was still a loss nonetheless. So here's the other added aspect of it. That $552,000 we built that up to was 100% tax-free. And this is for one car. So after the first 4 years, you'd never have to finance a car ever again. And think of it this way, too. What if you were to do this with two cars? So here's a way, and the luxury of this banking format is a way for you to actually turn your expenditures into a profit center instead of a net loss like it is for most everybody. So let's shift back here again to resume where we left off. All right, so here, let's start to take a look at the actual hard number. So what we're using as a vehicle for this, and this is the charm of infinite banking, is that we're using a life policy, because realistically there's three major pools of money in America: the government, the banks, and the insurance companies. That's where all the money typically resides. If GMAC needs money to lend for cars, they borrow from the insurance companies a pool of money. They charge more than the insurance company charges them, and they make that arbitrage. So you can't own the government, you can't own the bank. Technically, it'd be very costly and difficult. You need a charter and a lot of money to get some launched. But I can own a part of an insurance company, and there's a handful of ones that allow me to have a piece of them where I get the benefit from the proceeds of the company's activities. And so that's how we like to try to engage. But just to give you just a stay on a more high-level view of it, here becomes the difference. So this is a traditional life insurance product right here. And this was part of the discovery of how to better utilize this tool. If life insurance is traditionally sold for one day you will be dead and some other person will have money. While you live, it will represent a bill. How large of a bill would you like to have? So there's typically no advantage to the person other than peace of mind by owning the life insurance. However, in the infinite banking process, we actually make the policy perform differently, and this is going to show you how the difference is demonstrated. So, as a simple example, if you're paying $10,000 a year, you have a death benefit, you have zero in the way of cash value. This column here would represent what would be called the bank, and every company may have a different title for it. In this particular one, they call it the cash value at the end of the year, and that's how much money the person would take out. So in that example that I gave earlier where you had a $9,000, you capitalized your business and then you took out all that money, this one actually shows zero. There's nothing to take out. What you do, if you go to the further right, see, you have a death benefit of $796,000. So from an investment standpoint, this is a darn good investment, because if I want my wife to be protected and I spend $10,000 and 2 weeks later I have a massive heart attack, she gets $796,000, which is a better return on investment than just about anything else I could have done for my family. But the problem is I'm dead. And the question I always ask of everybody is, what's more important for you? Money for some other person for when you're dead, or money for you when you live? And I don't care if they're 20 years old or 85 years old, they always tell me they would prefer to have the money when they live. So I tell them we're going to be able to get to do a little best of both worlds, because we're going to build a bank version of this very same product. So this very same thing you see above, now totally reconfigured to become a bank, to be designed to function for life and to minimize its health or what it functions for in death. Take a look at this. We still put that same $10,000 in there, but now look, there's $5,762 available in what would again be the banking column. But here's where the difference became. Now look to the far right and you'll notice that the death benefit is reduced to $345,000. So it used to be $796,000, but now it's $345,000. And kind of a visual way to figure out what sort of happened there was we took this policy in a way because we can manipulate it through the software in the way it's allowed to be manipulated inside the rules of the IRS and the rules of what represents state-regulated life insurance. It's like having a very long balloon, like one of those little hot dog balloons, and you squeeze the one end of it, about half of the balloon, you squeeze it down super small to nothing. Well, the air did not leave the balloon, it just went somewhere else. So that's technically kind of what we did here. We were able to squeeze the death benefit down to a much lower number, which forced the money to go somewhere else that represented that $10,000 that was going into this thing. So to kind of get a look at it in a kind of a printed out way, this is a hypothetical 35-year-old male, and we're using a whole life product. It doesn't only have to be whole life, but this is an easy one to use for demonstration purposes. And lo and behold, this represents what we just saw a little earlier. Because you'll notice we're putting in $9,000, and then we look to the right where it says loan amount available, and it says $5,851. Well, that's what I was showing that you could take out at the end of the first year, if this was in fact your business, which this column represents your ledger sheet for your business. Now, we're not doing anything active here. I'm just demonstrating what's available, because what we're going to show next is if you actually put this to work, what would start to happen. So in year 2, we put in $9,000, and then you'll see we take out $6,225, and next year's $9,000, and we can take out $8,503, and then we put in $9,000, and we can take out $9,911. So that's where it got better than all the preceding years where you took out more than you put in. But look at how it starts to grow after that. Still, we put in $9,000, we get to take out $10,000, and just keep looking down. We get to take out $10,800, $11,300. 11.9. So as you see, if you're trying to finance a vehicle or a car or buy something just by running your cash flow and not having to earn any more money or do any other investing, exponentially your available disposable income will increase all by itself in the background. And you'll notice you're running total column. And at the same time, if we go all the way over to the death benefit, it started at $306,534, but you'll notice that that's increasing every year as well. Well, let's take it down to its summation here. So we've put in a total of $105,000 over the course of 15 years, and yet our available money to call up and retrieve is $160,000. So I've really got $55,000 extra dollars that I could use to buy a investment property or anything else that I chose to without me having to figure out how to invest or come up with any money other than making use of my own cash flow. I've delivered to myself $19,000 in dividends, and my death benefit has increased to $562,000. So I am taking care of that person for when I am deceased, but I'm actually built myself a very active financial tool now for when I do live. But let's get excited about this a little bit, because this already looks pretty good, but this is just a passive savings activity here that's going on. I'm not actually borrowing any of these loan amounts available. I'm just watching them and getting excited about them as the consumer of this. But let's see what happens if I actually get smart and really start to turn this into a true business and start to work this money for a change. So now let's take that same identical example, but we're now going to start taking some loans here. Now let's start seeing what happens. So let's start with that first year once again, because that's the parallel year. We're at $9,000 going in, and we've got that $5,851 that we can borrow, but yet we decide to borrow that out and charge ourselves 20% interest on that money. And this is a figure that you can select. You can charge yourself as little as the policy itself requires, which is oftentimes as little as a few percent, 4% or so, so a relatively low number. We would recommend you charge yourself a conventional interest rate. So in that auto example, it was an 8.5%. You could charge yourself that. On the baseline, the recommendation would be to charge yourself 10%. But let's get a little aggressive and charge 20% to show how much more powerful we can make this if we really kind of go for the gusto. So we collect 1,170. So in the next year, we put in our 9,000, but we're actually putting in 9,000 plus 1,170 in collected interest. So you'll notice now how this starts to affect our loan amount available. And if we consistently borrow and pay interest every single year, you'll see as we progress along here the magnitude which that will grow, and then we take it back down to its summation. And for speeding sake, I'm being a little fast here for everybody. It's that same 105, but we pumped in an extra 39,417 in interest that we built through those years, which built my running total of available funds up to 184,000 and increased my dividend level to 28,000, because the dividends is almost like reinvesting into a company and getting more shares. So every time I reinvest my dividends, I'm increasing my base, even though I still have the same principal amount going in. It's an ever-increasing pool of money that I'm earning a triple compound interest rate against. And now my new death benefit has actually grown all the way up to $645,000 over that same time window. So glance quickly at those bottom numbers again, because I'm going to zip back to the preceding screen just to give you a pretty strong perspective. $645,000 death benefit, $184,000 running total, $105,000 we put in, $160,562. So quite the difference. So let's just take a little recap here. So you were able to leverage all your money, and this is the thing we didn't discuss, but that's the other aspect of what the bank does. Not only are they recycling, but they're leveraging. They're using the same money in two places at once. So you've got $10,000 deposited at the bank, and then they concurrently have that $10,000 loaned out. So that same money is doing double duty. The average person is doing little or no leveraging, and then they're definitely typically doing no recycling. Now, the other nice thing about this, though, is when I pulled the money out of here, I was able to do anything that I wanted with it. Even within my self-directed IRA, there's a few things I'm not allowed to buy. But with this, I can get anything I want in the U.S. or anywhere in the world. I can do anything I want with this money with no permission from anybody but from myself, because I'm in total control. 100% of my accumulation is tax-free. I've increased in my example that we just showed here, by just actually utilizing those funds by being the bank, I increased my loanable amount by over 14%, I increased the death benefit by over 15%, and I increased my dividend growth by over 50%. And so here's a key kind of way to think of this. Whenever you borrow from a bank, it costs you interest, but when you borrow from your own bank, that same borrowing makes you interest. So that kind of is the essence of that side. But what are some of the other things you actually get to? Because here's some other aspects that are pretty exciting in and of themselves. You get to look poor on paper, which is always quite fun. So that all the funds you accumulate this way, of all of the other ones that we showed over on that other screen with all the choices you had of ways to accumulate money, only this one allows you to not have any wealth or money at all based on what's inside this thing for any loan purposes, for the bank, schools, student loans, bankruptcy, when you try to draw Social Security into the future. You avoid all that Social Security tax too by shifting those funds around in a way that by the time you're going to need them, they're now all tax-free, and we kind of defeat that whole little grid of all those tax options. And also in most states, it's totally creditor and judgment proof. So if your business capital is contained in here and your business gets sued or has to go bankrupt, you don't lose all your money. You can restart your business and your life's not devastated because none of that stuff's attached or taken away from you. And most importantly, compared to most of all those other vehicles too, short of like a self-directed IRA as an example, you retain full liquidity and control of all of the equity in the account to do with as you wish. But a special added perk we bring to the table by owning our bank, we get to pay it back at our own discretion or not at all, which means that in a normal loan environment, if I get a credit line, at the end of 30 days, I got to make my first credit payment, and they've told me how much that is. I can put the funds in my bank, borrow it out, and decide I'm not going to pay anything back for the first 2 years because it's going to take that long for me to get profitable, and then I'll begin making payments, and I dictate if they're going to start at $50 a month or $100 a month and then grow up to $500 a month, or I drop them back to $50 a month, or I postpone them for 2 or 3 years at a clip, or I decide not to settle for them at all and let the company settle for me when I do die because they'll take whatever I borrowed but didn't pay back out of the death benefit in the very end. So it gives me the maximum amount of control. Of course, we don't recommend all those options, but that just shows you the flexibility that's at your disposal. But there's actually more. If you're owning a business, here's another little consideration as well. You can set up a policy to receive the money that you were going to get from the sale of that business so that it lands in a protected place where it's going to be able to grow tax-free and generate a very nice return at the same time. Or if the money's to be inherited, or you're going to leave money to children. So those represent some of the key areas, and now we're going to open this thing up for questions. Oh, and by the way, as a little PS, at 65, the death benefit was over $900,000 in that prior example we were going through, and we would have had $450,000 in ever-growing cash value to live off throughout retirement, all tax-free. We did receive some questions, so let's throw some of those up there right away. And please, respond or send any others in as you have, and then Aaron's going to field some of those here momentarily. So it's asking here, this first question came in, what legal framework do I need to set up, an LLC, a C Corp? Well, for the purposes of the insurance, you're not going to want to set up any kind of an entity for the most part. There's greater advantages to owning it privately and then loaning the money to a corporation because I can make arbitrage by lending for my low rate to a corporation at a high rate. The corporation gets a tax write-off, and then I get to receive the interest income. So that's kind of a little more of a discussion for another time type of thing. Now, where a company may want to own it is, let's say that you're in a company and you want that company to be able to have a capital fund or have monies for what it needs to do. The company can buy a policy on the principal or that key person, typically called key man insurance. So it could be like the owner or a couple of the key players in the company, or somebody who's like the office manager or the warehouse manager, somebody that's a very important person and would be considered a key person within the company. The company can own a policy on that person, and then the company benefits from all these growth activities that we described up till now. The other question, if I'm my own bank, then does this do away with bank fees? laugh out loud. Well, it does away with any of the fear of bounced checks or any of those types of fees, but it doesn't preclude you from charging a lot of fees upon yourself for you to make a lot more money in your bank. And a lot of people do that. They charge themselves low interest to begin with, and 2 or 3 years later they're charging themselves 20% interest when they get a car loan and things of that nature. No, on the number 3, you cannot use an IRA or a 401k. That is one of the prohibitive things that you are not allowed to buy within them. So what ends up happening is this is a very good adjunct. That's why I'm here with iPlan today. A lot of people will have a series of bank programs for financing activities and additional retirement incomes in addition to their IRA, because the IRA has limitations as to how much money typically you can put into it. So I may have more money to run with on my cash flow, or I have my invested money in my IRA and I use the banks for my cash flow. So it's a good little 1-2 punch by having these work in tandem. Number 4, when dealing with
Oh,
yes?
Jeff, I'm sorry. Let me just cut in regards to using the IRA or 401k. After Jeff goes over all the questions, I'll be putting up just kind of a thank you screen, and it'll have our contact info. I would suggest contacting us for a strategy session. We are offering free IRA strategy sessions, so we can kind of discuss your options further.
Perfect. And me similarly, so because everything is customized in all of this stuff to the individual and their goals and needs and cash flow and everything else. So, but these are all very good general questions. When dealing with properties, how much in advance notice and what procedures do we need to give or do transfer money? Well, in terms of for the policies, and Aaron can chime in real quickly on how fast you can access funds from them, it's just a phone call away. Most of the companies want to send you a physical check. So if you call them on a Monday early enough, by either Monday day or Tuesday morning, they will physically U.S. mail a check to you. So it'll usually come within a handful of days, depending on where you live in the United States. Aaron, what's kind of access for the self-directed?
Yeah, when it comes to self-directing to invest in properties, our turnaround time is up to 3 business days. Now, our girls, for those of you that have an account with us, I'm sure you already know, the girls on the processing team are very quick, so they're usually able to get it done within 1 to 2 business days if everything looks good on the paperwork. If it doesn't, we'll contact you and your title agency or your attorney immediately and let you know and work with you to kind of get it fixed so that we can get those funds sent out as quickly as possible for you.
Perfect. So in either instance, it's quite quick. And then mine is situation, and you can address yours too as well, because it would probably be a benefit for them to know. Initial investment on the bank portion is very nominal. Now, first of all, there's no payments to me or the companies or anything. 100% of the money you put in is the money that's working for you. Everybody else gets compensated independently of that, so there's no, like when you do stocks, the broker's going to take a part of those funds and that becomes their commission. In the banking stuff, we get commissioned by the companies, and it does not deprive the client of any of the 100% of money that they put into the thing. But it can be as low as $50 a month, or again, it can be paid monthly or annually, or it's kind of whatever the person prefers. But it can be very low, surprisingly. Obviously, the more that they are able to devote to it, the better, because the growth is that much more dramatic. What I usually do with everybody is we work on developing their cash flow overall, so we try to figure out where they have other leakage or inefficiencies, and we may start with a $100 a month program, but we soon discover another $100, and we keep growing it. And I have clients that have more than 8 or 10 different banking programs going, so you're not limited to one. And what's this last question? I'm not even sure if this is a question. I don't even totally understand what that person's exactly asking on that 6th question.
I think they're trying to understand the best way to be their own bank, essentially, without using a regular bank.
Well, you're still forced to use a regular. Okay, well, that's just, let's treat it as that being the question, because that's a nice one. How do you interface with this? The bank that you would own is only going to typically, you can send an incremental money. If you're paying yourself back on a monthly basis, you can send them money dribs and drabs. But when you request money from the bank, you're invariably requesting lump sums. So if you say, I need to send me $10,000, that has to go somewhere. So you do still have a conventional bank to receive the money and for you to disperse it. Some people don't pay their bank back monthly. They'll pay it back periodically, so they'll make payments back to their bank account, sometimes a separate bank account they've set up. Like Nancy's bank, and it's just a parallel checking account they have with their normal bank. And every time they accrue like $500 or something in there, then they'll write a check back to themselves or their bank policy to do so. Were there any other questions that you saw, Aaron?
I think we do have a question here. It looks like somebody is asking whether or not you're talking about whole life insurance.
It doesn't have to be. Oftentimes it is. It depends on accessibility. We'll oftentimes also use index universal life. They both lend themselves to banking properties. One is for a more immediate and faster banking needs, and the other is for a more long-term growth or trying to get towards generating a retirement income stream, which will be much more substantial than you'll typically get from the whole life plan. But most of the clients I work with typically have both. And we have a strategy because, we're trying to analyze what they're looking to buy now or subsequently, and we figure out which ones match up best to get to that overall plan and then to that final retirement.
Perfect. And then just the last question, somebody asked if they will be able to get a recording of the webinar afterwards. So we did record the webinar, and within the next day or two, we should be emailing out a copy of the webinar to all attendees. So you guys should be receiving it in the next couple of days. It looks like that's the end of our the questions that we have here. Jeff, thank you so much for doing this, and everybody else, thank you for joining us.
One thing, Aaron,
like I said, you'll be receiving in. Oh, go ahead.
I was going to say one thing. Anybody that's sat through this so far today, we are going to be doing a new one again at 8 o'clock tonight. So if you're inclined to have somebody sit through this fresh for themselves, send them your link and have them come on for tonight.
Absolutely, absolutely. And I think that's it. So on behalf of iPlan Group and I believe Jeff as well, thank you for joining us and taking the time to view the presentation. We hope everybody has a great rest of the day.
Thanks all.